All right, we'll go ahead and get started and just let everyone fill in just as time goes on. Good afternoon, everyone, and welcome to our webinar today. Today, our topic is tracking a shifting economy, the role of job posting data. My name is Kevin Miller. I'm the Vice President of Marketing here at Chmura, and I will serve as your host today. Before we get started, I do have a few housekeeping items to quickly go over. People always ask, usually during the webinars, if we will send out slides and a recording, and the answer to that is yes. We will go ahead and send an email out soon. We either get it out this same afternoon or it might be tomorrow morning with a link to a recording of the webinar and a link to download the slides. So just go ahead and keep an eye out for that. For folks that don't make the live version as well, we send it out to everyone who registers. The other thing I'd love to say to everyone is during the webinar, please ask us questions. We highly encourage participation via questions. And the best way to do that is to put your questions in the chat. At any point during the webinar, if something comes up, just go ahead and put it in there, and then we'll try to get to as many questions as we can towards the end. One housekeeping thing, if you do see your question disappear from the chat, don't worry about it. I tend to move some of them into the Q&A tab just because it's easier to keep things organized so that we can get to as many of those questions as we can towards the end. And with all that said, we're going to go ahead and get started. So our speakers today will be Dr. Chris Chmura, the founder, CEO, and chief economist of Chmura Economics and Analytics, and Dr. Francesco Renna, a senior economist who joined our team just a few months ago. For those of you who are new to our webinars, we do like to start with a quick overview of who we are and what it is that we do as a company. And as a company, we provide labor market data and analysis through three main offerings: our Jobs EQ software, consulting, and data. We were founded in 1998 by Chris, who you will hear from today. We have offices in Richmond, Virginia, where the three of us are located, and Cleveland, Ohio, but we truly serve hundreds of clients all over the country. And just as a team, some of the things that really drive us is we truly care about helping our clients get access to the data they need, which will help their communities and organizations grow. And really, just as a guiding principle for us is excellence. Excellence guides us and is always what we strive for in customer service and data quality. And we often do hear from clients about how these two things differentiate us from similar products that are out in the market. Speaking of the markets, the primary audience we serve are in 6 verticals. Those being, we serve corporations, HR, talent acquisition, and other corporate functions, economic development, education, site selection, staffing, and workforce. And just to get a sense of who those organizations that we do serve within those verticals are, here you can see a representative sample of some of those clients that we serve. You'll see anything ranging from major corporate and consulting clients through 2- and 4-year educational institutions to public sector clients in economic development and workforce. Now, with all that said, I'll go ahead and turn it over to Chris.
Great. Thank you, Kevin. Now you see on your screen our weekly economic update. This is something that we provide complimentary to clients and non-clients as well, and comes out on a weekly basis. And I think it's very timely right now with the economy and all the uncertainty. We give you some information on the first page about what came out last week, what's coming out the upcoming week in terms of economic news. We provide some highlights about what it means. If the Fed has spoken, we talk about the implications for monetary policy, that is how it might increase in interest rates. And then we provide our own forecast of interest rates in the financial markets. So please sign up for that. You can click on this link here or go to our website and all the way down at the bottom of the home page. Also, just one other piece of information before we get started. We will be having another Jobs EQ Users Conference in January, last week of January, down at Universal Orlando, Portofino Bay Hotel. And if you've looked at the site, you probably think I can't afford it at $500 a night. We got a great rate of somewhere around $279, and there's no resort fee. Those rooms are only based on availability. We just have a certain number of them. And also, I think if you were bringing your family or friends down, you can get the same rate 3 days before or after the event. So we'd love to see you there. Our past events have been a lot of fun, a lot of learning, and getting to know other Jobs EQ users. So with that, on the agenda today, first we'll talk about the national economy. I'll give you an overview on that, and then we'll hand it over to Francesco, who will give you a lot more detail on using LMI and job postings data to understand what's going on in the economy. Things seem to be always changing pretty fast. If we do end up in a recession, and we are still forecasting one, we would expect it to differ by region. Francesco will talk to you a little bit about how you can see some of those changes. And also in terms of occupations, some will be more vulnerable than others as we go through a downturn, and he'll walk you through navigating through a recovery and identifying skill sets needed to have a competitive labor market. So with that, let me move on first to the national overview. So here, a current state of the economy. We are starting to see the labor market cool, but it's happening very slowly. The unemployment rate remains very low. Initial unemployment claims are a leading indicator of the job market over employment. They are starting to inch up. Job postings are even a more leading indicator of employment. And Francesco will give you a lot more detail on this, but as of July 4th, when we look at job postings from a year ago, we're 27% lower. So clearly, businesses are more apprehensive about what's coming, perhaps seeing some slowdown in some of their industries, and they're not posting as many jobs. The financial market has been under stress. We had the 3 regional banks that failed since March 2023. That tends to make credit harder to get. Interest rates higher on the credit side. The Federal Reserve has increased the federal funds rate target by more than 500 percentage points very quickly over a short period of time. And as a result, the yield on the 3-month Treasury bill is 5.24, higher than the 10-year note, which is 3.76, which means that the curve is inverted. So typically for the longer you hold a Treasury note or a Treasury bill, the higher the interest rate. In this case, the opposite is true, and an inverted yield curve is one of the best predictors of a recession. It has historically been. In terms of GDP and the major components, we're seeing that private investment is down, so that would be investment from businesses, residential, and it's mainly being driven by a drop-off in residential construction. To some degree on the business side, we're seeing that slowing. Personal spending continues to grow, and that's very important because personal spending or consumer spending makes up about 70% of GDP. So once we start to see that slow, it would portend perhaps a recession very imminent. So first, our forecast. So here we're looking at GDP. It's the broadest indicator of economic activity. And you see the COVID recession, the Great Recession prior to that, which was the worst recession since the Great Depression. And then here in red, we're looking at our forecast. So we're expecting a slow quarter in the upcoming quarter, then that's the second quarter. Third and fourth quarters, we still have a decline, recession in our forecast, and then starting to see some growth after that. Typically, if we're seeing growth of around 2 to 3%, that's considered very good growth. So here you can see these numbers here are around 2%, this number above it, but not consistently as strong as what we saw in the late 2017-2018 period, where we had a very strong economy before going into the COVID recession. So on our next slide, I'm now going to take you through some of the indicators that the NBER looks at. So if you've been in our webinars before, you know that the National Bureau of Economic Research is the arbiter of recessions. The previous chart showed us quarterly data. The NBER looks at monthly data to determine when we go into recession. They define as a broad decline in many indicators, not just GDP. So here you can see that we had a strong decline in employment when we went into the COVID recession, and here it came out pretty strong, and it has been slowing, but we're still seeing pretty good growth of 100 to 200,000 jobs on a monthly basis. Another indicator that the NBER looks at is the unemployment rate. So just the opposite of employment here. And we're looking at numbers that are still almost as low as they were in the very strong economy prior to the COVID recession. Part of this low unemployment rate is because people are still sitting out of the market. They're not coming back into the labor market. And so the participation rate still remains lower than it was when we went in before COVID. Now, industrial production is another indicator that the NBER looks at. And in this case, we're looking at output or production at manufacturing, mining, and utilities. And here you can see that it has been a bit volatile lately, and it has slowed from the increases we saw earlier on coming out of COVID. And I wanted to point out during the Great Recession, and this is typical, that you could have a growing industrial output, and then boom, you go into a recession and it starts to drop off. So once again, just because we haven't seen it in this particular month, the latest month of data, doesn't mean that we won't start seeing a fairly good drop off in the next couple of months. And I'll end with a slide that I hope will give some better color on why we would expect that to happen, or how that could happen. Inflation adjusted consumer spending. So again, very important. This makes up 70% of GDP overall. Look at our last recession here. You can see where it turned very slowly until we were about a year in. Then we saw some steeper declines. Notice again, coming out of COVID, some very sharp gains. And now it basically over the last 3 months has been pretty much flat. And once again, that's adjusted for inflation. So we take inflation out of that. So why do we still expect a recession? Since those numbers are showing some slowing, but they're not showing the sharp decline that you would expect going into a recession. One big reason is it takes a year or longer for increases in the federal funds rate to impact the economy. And that's because we have contracts that are in place. You may have a contract to build a home or a contract to build an office building. And even though rates are going up, you might have locked in your rate earlier, but eventually those higher rates are going to go up and they're going to impact business spending. They're going to impact consumer spending. We talked a little bit about the banking crisis, and that further tightens credit. There's not as much credit that's available. There's not as much deposits flowing into the banks. So the banks don't have as much to loan out in the way of loans to businesses and individuals. We're also starting to see credit usage rising. It hadn't been for a year or two going into COVID, in part because of all the stimulus money we were getting from the federal government on the household side. But credit usage is going up. That's also suggesting that, of course, individuals don't have as much in saving. And then secondly, that inflation is having an impact, and they're having to dip into using credit to maintain that same standard of living that they had been used to. Student loans repayments will start September, October timeframe. So I believe it ends September 1st, and then October 1st is when the students will have to start paying their loans back. These individuals had money that they didn't have to pay off in terms of student loans that they had been spending, presumably in the economy, and now they're going to have to shift toward taking some money that they would have spent in the economy back to paying off loans. And then finally, as I said earlier, the inverted yield curve historically signaled a recession. On the labor market side, again, we are seeing some softening. Jobless claims are up. Job postings have declined, and you'll see a whole lot of good information from Francesco on that in more detail, and consumer spending has begun to slow. And my final chart before sending it over to Francesco is one that I like to look at, because we economists sometimes say that we worry about the economy when imbalances start to show up. So here's an example of an imbalance. I'm showing you retail sales and I'm showing you inventories. So in this case, when we went into COVID, there was not as many sales. Inventories declined. But then as we started to come out and start to be able to spend on goods, you see that at some point, consumers didn't spend as much. So retail sales, this is percent change from a year ago, was running almost 20%, slow to about 10%, and now is only growing about 3 or 4% from a year ago. So when that happens, in this case, when we have a shift, a slowdown, and the storekeepers aren't expecting it, the auto dealers aren't expecting it, then what happens is they end up with more inventories in their stores. And when they have more inventories in their stores, they don't purchase as much from the factories. And when they don't purchase as much from the factories, the factory orders start to slow and output starts to slow, as you saw on an earlier chart. And then if that continues, the factory owners or managers will lay people off. Those people who are laid off won't spend as much. The unemployment rate will start to rise, and it snowballs into a recession. So this could be the very beginnings of that recession we could continue to talk about. This is one indicator, the sales and inventory ratio that I'm continuing to watch very closely. So again, bottom line, we still expect a recession, a modest one, and we're watching many indicators, job postings being one of them, to give us a sense of how quickly it's coming, what will it look like, and how will it affect your regions. So with that, let me hand it over to Francesco.
Thank you, Chris. Can you hear me okay? Okay, I guess that's a
Yes.
yes. So
Yes, we can hear
I'm
you.
gonna discuss a little bit about what is going on right now in the economy from the point of view of employers. And it's important to keep in mind that while the talk is going to be in light of this possible recession coming in second half of 2023, the underlying idea is that there are some big changes, and using job posting data can help us to understand what's going on with or without the recession, because there are some, as I'm going to point out here and there, some dramatic changes in the economy that's going to be important to identify in order to be more successful and be prepared for these changes, which could be independent from the recession. So the first part is, let's compare the story that we get about the economy from the traditional labor market indicators compared to some job posting data. And I'm going to use, when I talk about job posting data, I'm going to be using mainly or exclusively our real-time intelligence data, which is proprietary information of our Jobs EQ platform. So every time there is a recession, of course, many sectors of the economies are affected by the recession, but it seems like every recession is unique in the way that it tends to impact some industry harder than other industry. For example, if you look back at the Great Recession, construction, due to all the chaos in the housing market, construction was the sector was hit the hardest, together with the banking and mortgage system that was due to the bundling of good mortgages with bad mortgages, and created that confusion about the quality of the mortgages when banks were co-insuring mortgages from one to the other. And that led to the big financial collapse of 2007. During the COVID recession, we noticed that it was mostly a female-dominated industry that were affected the hardest, because women tend to work more in leisure and hospitality and retail, which were the industry that were affected the most by the shutdown of the economies and by the stay-at-home orders. What is then the possible outlook of a recession in the second half of 2023? Our intuition is that during the recovery after the COVID recession, some industry really went crazy hiring. They ramped up on employment, and probably they hire more than they should have, or more than their long-term trend. And so now some of the the cutback on unemployment that we observe is actually just a natural trend in this industry to go back to their long-term growth rate. If you look at the news, what we read constantly in the news is all this news about layoff in the housing sector. The big news usually are in the tech industry. They tend to always be very catchy. Everything that is about tech right now tends to attract more attention from the media, but that is where you hear the most about firms cutting back. And I'm going to show you why firms are cutting back. And in showing why, I'm going to rely most heavily on what we call traditional labor market indicators. So here we look at employment using the Bureau of Labor Statistics current employment survey in two sectors. One is healthcare, and the other is in mortgage and non-mortgage loan brokers. Why am I choosing these two industries? Because if we look at the growth rate of employment in these two industries, they really grow pretty much at the same speed from 2015 to 2020. Then COVID happened, and then I don't have to tell you what happened in the housing market and all the craziness that followed the need of moving to a bigger place because we have to work from home, so we need to have a dedicated space to work from home. So there was an increased demand for housing, compounded with extremely low interest rates, and the fact that there was more cash in the hands of consumers due to federal programs. They put money in the hands of the consumers, but also because consumers could not spend money on services, so they had all this extra cash. And so that all went into the increased demand for housing, which led to banks and lenders were not banking lenders to hire mortgage and non-mortgage loaners. So a huge spike in the level of hiring in that sector. And now what we observe is just that the sector is slowly going down to its long-term trend in light of also the dramatic cool-off on the housing market that is being hampered by the higher interest rates. Another sector that we see a lot of activities going on and where we see a lot of adjustments, what I would call adjustments, is the IT sector. This is going to be a little bit more complicated to explain for reasons that will become clear to you in a couple of slides. But another thing that happened during the COVID pandemic is this increased demand for services that were typically took place outside the house, but now they have to be implemented at home. So like working from home, entertainment was at home, gyms were closed, so you have to exercise at home, and that led to an increase in demand of bike services, paddle and Zoom services, and so on and so forth. So all these IT industry really started hiring like crazy because of this increased demand for IT. And now that we're slowly but surely coming back to a normal life, the demand for these IT services is just simply not as big as it was a year ago. And so firms are just adjusting to the new normal post-COVID. But if these are the two sectors that are most likely to be affected by the recession, what is the impact of the slowdown in employment in these two sectors in the entire country? Well, if you think about housing, housing is pretty much homogeneous. Every state has a constant share of the population that is involved with housing activities, either construction or transaction sales, and so on and so forth. But when we look at IT tends to be concentrated in very specific regions. And in the chart in front of you, in the map in front of you, I have identified the counties where there is the largest proportion of the population that is employed in what I call it IT sectors, which is identified by the occupation in the footnote of this chart. So clearly we see that some regions will be more exposed to the risk of a slowdown in the economy in terms of employment than other regions, simply because these regions rely more heavily on IT in order for the economy to grow. And of course, you're not surprised to see the famous hub for IT, which are San Francisco, the Seattle area where Amazon is, but also important hubs like Denver, Austin is also there, and the area around Washington, D.C. So those are going to be the area where probably the burden of the slowdown in the economy is going to be felt the strongest. So if we look at, Chris mentioned that if you look at all the jobs right now, all the job apps right now, we're 27% down compared to a year ago. But when you look at computer occupation only, we're down 40%. So clearly that is in line with the story that the sector, IT sector, is more currently is more sensible, is more sensitive to the slowdown in the activities. But what is interesting is that one feature that you can use in our job CQ is to sort out job ads by job status. If the job ad is a full-time job, or if the job ad is for the part-time job. And so what we see is that most of the slowdown is actually not for the full-time positions, but it is for the part-time positions. We also notice another thing. We notice that the number of job ads in computer occupation actually started to go up at the end of 2022 and into 2023. And the timing is very close to when OpenAI and ChatGPT really came in the market, and there was this rush, this race of trying to outbid the other companies. As a matter of fact, if you look at NASDAQ, which is heavily involved, has a heavy presence of IT sector companies, NASDAQ is actually up 30% from last fall. And one of the reasons why the NASDAQ has recovered so much from the losses during the pandemic is actually because of this huge investment in OpenAI. And this is to say, like, again, yes, there is a recession, but trying to understand, to track a moving economy is important, even independently from whether we have a recession, because there are a lot of changes that are happening right now. And we can use this tool, this job opening ads tool, in order to understand where are the movements, what movements would we see, where do we see them, and how can we use this information to come up stronger in the labor market. Another information that we can get from keeping track of these job ads is that even without the same occupation, when we look at two very similar jobs, one that is under the code, the SOC code 151211, which is computer system analyst, and the other that is 151212, which is information security analyst. Well, if you look at information security analyst, which is cybersecurity, basically, very popular job right now. There was actually no slowdown in the number of job activity until the end of spring, beginning of summer. So it's a new development. Besides being just like a new thing, it is like it's a new development in the area. What we see is that the number of job openings in computer system analysts, they're down 30% from a year ago. But for security analysts, they're only down 12%. So that sector seems to be more recession-proof or more robust to this change compared to computer system analysts. Why is that important? Because right now, if you look at the pure numbers of people employed in computer system analysts, that's a much bigger sector of the economy. It employs almost 500,000, more than 500,000 workers. Instead, information security analyst is much smaller, is a third of that, but it seems like it's growing faster than computer system analysts. So that's another piece of information that we can use in order to, if we are in an economic development, if we want to try to decide in which sector of the economy we should invest our resources. Another interesting fact that we can exploit by using this job posting is where these changes are happening. And it seems like at the beginning, this slowdown in job activities was mostly a problem of, I would say, the mega or the large cities or cities in the United States with more than 4 million people. And so in the graph in front of you, you have the number of activities in San Francisco, metropolitan statistical area, but also Seattle. And so we see that by the end of summer, beginning of fall of last year, the number of job ads has steadily been going down, and the gap has been growing over time. The rest of America was pretty much sheltered. Okay, so this was an issue. If you do this graph also for New York, Los Angeles, Chicago, Houston, Dallas, Detroit, Phoenix, Miami, you're going to get the same chart. But the rest of America seemed to be sheltered from this behavior until very recently. Okay, so here we have a graph for Richmond and Nashville metropolitan statistical area. But you could do the same graph for Memphis, Cleveland, Pittsburgh, Tucson, Denver, Atlantic City. You have the same story. Up to May, there was really not much difference in terms of economic activities in 2023 compared to a year earlier. But now we start seeing some slowdown even in these areas. So the slowdown that seemed to be only a factor of big cities is now spreading to also other metropolitan statistical area. And one may wonder why. Why is it the case? Well, large cities tend to be also cities that have a larger emphasis on IT sector. So it goes back to the IT being the main driver of this slowdown in economic activity, a slowdown that again is constantly evolving because of this new development in generative intelligence, artificial intelligence, generative AI. So we need to keep on monitoring what is likely to happen in the next months, on the months to come. If we break down the activity in job ads by educational level, then we do observe that while the trend in the last few weeks, in the last few months, is being downward across all educational levels, the largest gap is for jobs that require a minimum of a high school diploma or an equivalent. Technically speaking, we don't see, although it's slowing down, the numbers in job ads for positions that require a master's degree or a higher degree, professional or a PhD degree, they're still comparable to where we were a year ago. And job ads that require a minimum of an associate or bachelor degree are in between these two extreme cases. So what we got so far is that this slowdown in activities is not homogeneous across the state. There's going to be some regions that are going to be more likely to observe a larger drop in employment, at least looking right now at the demand from labor from the point of view of employers. We also see that all the regions that are most heavily dependent on IT sector will be more likely to see a slowdown in economic activities. And our model, the one that Chris presented, shows a decline in the GDP for the two last quarters of 2023, which our numbers seem to indicate is going to be of the same magnitude of the recession of the early 2000s. So not a large recession, but still a recession. And if you are the person that lost a job, it doesn't matter if it's a big recession or a large recession, you lost a job. So losing a job is one of the most traumatic experience that an individual can experience in his or her life. So what can we do in order to address the need and help people to come out of this slowdown of activities in a way that he or she is a winner at the end of this transition period. And so transition periods can actually be an opportunity to revamp the skill set of a region in a way that the region may come out actually stronger at the end of the transition. So what we discussed is the fact that some occupations seems to be more robust to these changes that are happening right now than other occupations. And one example was these two occupations that are very similar. They have a lot of crossover skill set, which is information security analyst versus computer system analyst. They have most very similar educational background, very similar experience and knowledge skills, but occupational information security analyst has a better career path or is a more positive perspective than consumer computer system analyst. So the idea is, how can we help transition people away from occupations they're, I don't want to say dying, but they're slowing down, they're becoming more obsolete, into occupations they're becoming more like the future. And again, information security analyst is basically job security, cyber security. Well, keep in mind that we are not predicting a larger recession. So we need to have some training that can help our workers to become more competitive in the future labor market. They don't require a long time to get trained for because we don't expect this one to last too long. So looking at any program that is like a certificate or almost a 2-year program seems to make the most sense, right? So that we can be ready for the next chapter. And here I'm just presenting it just for, as you know, it can be repeated for any region that you want to, but this is the one in front of you. Is just a case of the Detroit metropolitan statistical area, which compares the number of people that have a specific skill set. For example, the certified information system security professional, which is one of the titles, one of the skills that is required for an information security analyst job. So there are only 17% of the population that have that job, while there are employers, there's 26% of employers that are requiring that skill. So we have identified here a skill or a qualification that is in a gap, and this would be an opportunity to train our workforce in a way that now the skill set aligns with the needs of the demand from the employer point of view. And so we have aligned the labor force to what the demand for the future will be. And again, I'm not going to go through all the certificates that I identified for Detroit, because this is just an example. And the idea is that we can identify what skill set we need in order to meet the demand and to come out more competitive at the end of this transition. Another occupation that we have identified as very vulnerable to the current downturn would be the loan officer. And so another important tool, a tool that we can use in order to see, well, what can these people, this mass number of people that used to be a real estate agent, and then now most of them, unfortunately, are working as an Uber driver. What can we do now to train these people in a way that they can actually build a new career, given that the housing market is not clear if and when will bounce back? It seems like the IT sector, because of generative AI, may actually be able to come back pretty soon, but it's not clear when the housing market will be able to bounce back strong, or at least as strong as during the COVID. So we can use this tool of the willing and able that ranks all the possible occupations to a specific target occupation. In this case, is for loan officers. And in a 4-quadrant, the one above the horizontal lines are all the occupations that pay a wage that is above loan officers. And I did this one for Phoenix because it's one of the market that was the most, was one of the market that saw the real estate booming faster than the average for the country. So all the occupation below the horizontal line, they're not occupation that would be suitable alternative to loan officers because they pay less than loan officers. So no individual would be interested in these kind of jobs. So we can eliminate all these occupations. And then we have the one to the left and to the right of the yellow dot, which represents the loan officers. The one to the left are occupations that their skill set does not really match the skill set of a loan officer. So the one that we really need to pay attention are the one in the blue quadrant. Those are occupations that are very similar to loan officers, and they pay a salary that is equal or greater than a loan officer. So those would be very appealing. And the one that I have identified, for this specific example is underwriters. Why would underwriters be a good solution? Because look, most loan officers already have some underwriting skills, so it would be very simple for these people to make the transition from one occupation to the other, and again move out of any occupation that is struggling right now to an occupation that most likely is growing at a speed or a rate that is better than loan officers. Of course, there are other things to consider. Right now, underwriting, I don't know if I would recommend anybody to go into underwriting because it's one of the occupations that actually is projected to be destroyed by OpenAI. So I don't want you to go out there and tell people, oh, I heard by Chmura that we should all get underwriters, because we should not, we should consider that one. But this is, again, just in the scope of giving an example of how we can identify possible candidates to help people that lost a job, unfortunately, due to the slowdown in activities, and create a new career. So finally, I would like to conclude. I have 2 minutes, and then I would love to open the door for questions about today's presentation. We, as at Chmura, we expect a short, mild technical recession. Technical recession means 2 negative quarters growth rate of the GDP in the second half of 2023. We have, one of the main reasons why we stand by that statement is because we observe a sharp decline in economic activities. Looking at the real-time intelligence data, which is our job ads data, we saw a slowdown starting earlier in large metropolitan areas, dating back to actually a year ago, but now that slowdown is actually spreading to just about across all regions in the United States and all jobs. However, even if we see a slowdown across all regions and all occupations, in some occupations we see a faster slowdown than in other occupations. And so we can exploit this information to come out with more proactive actions of how to train our workforce into the occupations that probably are going to come up as the winner of this period of transition. And that's all I have for you guys.
Great, thanks, Francesco, and thanks, Chris. We do have a couple questions in the chat. I will say we have some time left over, so if there's anything that we didn't address or anything that was unclear, everyone feel free to drop more questions in the Q&A or the chat, and we can get to them. Chris, the first couple questions that popped up were, I think, when you were giving the overview of the national economy, and I think this one came in when you were talking about the inverted yield curve. But someone asked, being ignorant of economics, what exactly does this mean? Can you just give kind of a 5-second presentation on what the inverted yield curve means?
I don't think I could give it in 5 seconds, but that is a good question, and thanks for asking that. I often have a picture of the inverted yield curve. can we flip back real fast to the second slide here? So basically, the yield curve is when we look at, maybe you can do this faster, Kevin. I'm trying to get to where people
Yeah,
can sign up.
I'll
Okay.
do it while you talk.
Okay. So if you purchase a 3-month Treasury bill right now, you may get 5%. And, well, let me say this differently. If you purchased a 3-month Treasury bill a year or two ago, you would probably get 0.1%. Interest rates were very low. And if you purchased a 1-year Treasury bill, it would be higher. It may be 0.3, and then 5-year even higher than that, 0.75, 30-year even higher, maybe 2%. And so we're still moving toward it here. At the bottom, okay, here we are. Now, right here is the yield curve. Can you see when I'm moving my cursor? Can you see my cursor moving on
No.
the screen? No, okay.
No.
So if you look at the third page of the weekly economic update, and if you look at the very bottom, that's the Treasury curve. There you go. Thank you for that circle. So on the bottom, the horizontal axis is the maturity. So the longer you hold something, the greater the risk, the higher the interest rate you require, and the lower the risk, the shorter the term, the lower the risk. And so these yield curves are what you kind of typically see, but when the Federal Reserve starts increasing the federal funds rate, that's an overnight rate that banks use to loan to each other, it tends to push up lower yielding treasuries. So the 3-month yield goes up, continues to go up, but at the long end, we're not seeing the 30-year going up, or the 10-year is the one that we usually track it against. And so the Fed keeps on pushing up interest rates. You end up with a 3-month bill that's like 5.45%, well, close to where it is right now. I think it's come down a little. And then the 10-year note is in the upper 3%. So that's saying that investors believe that some point in the future, the Fed is going to start to lower interest rates. And so that's why the yield is staying so low at the longer term. So that's called an inverted yield curve. And if we look at it historically, we've always seen the curve invert before a recession. I don't know if you can add any other simplicity to that, Francesco, that I left out in just a few seconds.
No,
That was enough.
I wish I could create a chart very quickly from Fred and share it, but I was planning to do that while you were talking, but I was not as fast as. But yes.
Yeah, Lundell, I write a column for the Richmond Times-Dispatch on the economy every month, and if you let your account manager know you have this question, I wrote a column not too long ago on that subject, why it happens and why it's why we see recessions afterwards. So I'd be glad to send you a copy of that. If you don't have an account manager, then send it to me, Chris@Chmura.com.
Thanks, Chris. Next question we have was, are we seeing individual spending increase as a result of increased prices due to inflation, or are people still spending more since there were supply constraints during COVID?
I can start on that.
Yeah.
I think the supply constraints, for the most part, have gone away. I think if we did show you inflation today, what you would see is that inflation overall has come down. Inflation for goods have come down pretty strongly, but inflation for services is still pretty high, and I believe it's still going up. That's been happening since we saw a shift from people buying the Pelotons and the all the Lululemon clothes, because you can only see the top half of you on your Zoom meetings. So we've seen a reduction in spending on goods. So the inflation for goods has gone down, but people are going on vacations more, the airplane traffic is up. And so we're seeing the price of services in part because we just can't get enough labor to be at all these hotels and the restaurants that have reopened. So I would say at this point, the supply constraint issue has for the most part gone away. I mean, there are some, and even recently we heard about issues with grain coming out of Ukraine, maybe causing further problems around the world. But right now, I think it's still too much money chasing too few goods. Francesco, would you agree?
Yes, I agree. And then as a reminder, the chart that Chris, you presented is adjusted for inflation. So that's already been taken care of, that that has been addressed. The inflation component is being removed from the data. If you were not, otherwise consumption would have been much larger with inflation. Yes. So after we remove inflation, it's pretty flat.
Right. So yes, Francesco's referring to the consumer expenditure graph that under my series of NBER charts.
Great. Thanks, Chris. A question that did come in while Francesco was speaking was, can you share the reports to create this information so we can run our own state?
Chris, I'm going to let you answer this question.
I think I'm going to let marketing answer this question.
Yes, all of the information that was in Francesco's presentation is available with our Jobs EQ platform. So I know we have a lot of users of the tool that are on this webinar, and we'd love to have you, but if you have a specific interest in learning more about Jobs EQ, you can visit our website, fill out a form, and we will have somebody get back to you very, very, very shortly.
Yeah, that was better than I could have done.
Yeah, and then another question that came in, is there any specific methodology for using job postings to create growth forecasts?
So, Francesco, I know that you've been fooling around with that. So, and will you be writing a blog, or have you written a blog?
No, but the forecasts are based on the BLS forecast. So the forecast in the future are only based on the prediction from the Bureau of Labor Statistics.
So yeah, in our when we're looking at forecasts for employment and occupations by region, it's based on how that industry will perform at a 4-digit industry level in the U.S. So demographics are taken into account, onshoring, offshoring, and then we also take into account in the region the demographics of the region, the historical growth rates will create the forecast. But if I'm understanding Drew's question here, I think he's saying, do you have a methodology for using? We've said that job postings are a predictor of non-farm and payroll employment.
Oh.
Do we have a methodology that, a specific methodology that forecasts non-farm payroll employment based on our RTI job postings?
So we don't have a methodology itself, but we do find that there is a very strong correlation between job posting numbers and GDP numbers. And that's why we predict a slowdown in economic activity in the second half of 2023 because of this strong correlation. I forgot the correlation number. I think it's about 70%, which is pretty large. And so if that holds true, then the slowdown that we observe that's why we call it a leading indicator, the slowdown in job ads should translate into a slowdown of the GDP in the second half of 2023. Drew, does that answer the question? There's a question. One region has seen an average quarterly growth in posting over the past 6 quarters. And Drew, what is your region?
Is it someplace in the Midwest, I would guess, or Northeast? Anchorage. Mm. Mm. That that is an interesting one. Drew, we should probably talk offline. It and I wonder if it's a seasonal thing going on with the growth right now, or is it related to some specific um, oil, gas, or private sector firms that are seeing a spurt of growth. But yeah, for sure, Drew, write to me. Believe it or not, I think my name in this case is easier to figure out. Chris@chmura.com, and I'll bring Francesco in, and we can talk to you and see if we could figure out what you're seeing there.
And I just can, if I can add a few words.
Sure.
Alaska is always a difficult state to study because it's different from all the other ones. If you think about tourism, it's very seasonal. So seasonality plays a big role in Alaska more than in other states because of the weather condition. So that may be one of the reasons.
Yeah, but I've been to Alaska before. A beautiful, beautiful state to be in.
All right. I think that was all that we had for questions. I did drop the link to the yield curve blog in the chat if anyone was interested in pulling it from there, and then also had the link to the weekly economic update sign up form. So I think that was about all we had. Chris, do you want to go ahead and wrap us up?
Sure. Thank you again for attending, Francesco and Kevin for leading, and Francesco for all the good information that you gave us. We're happy to continue to do these webinars in the future as the economy unfolds and as we think we're moving toward this recession. But please let us know of topics that are of interest to you, and would be glad to consider them. So thanks to you who are clients and you who are not. We look forward to talking to you. Have a good day.